Hi, everybody! If you're a young person that is many years away from needing to live off of your dividends, then this video is especially for you. Check this out. Starting around 1990, AT&T has a price return of 45%, and Verizon is even yuckier at 0.97%. Now, if we look at total return, which includes interest, capital gains, dividends, and realized distributions, AT&T looks a bit better with a return of 427%, while Verizon only has a 132% return. But if we look at the S&P 500, which tracks the stock performance of 500 large companies listed on US exchanges, we see that has a gain of 1,450%, which is 239% greater than AT&T. So if you're a young investor who's singing, your money would have been way better just parking it in the S&P 500. Although it didn't start to significantly outperform AT&T until summer of 2017 when Baby Driver was tearing up the silver screen. I think that AT&T and Verizon should be thought of as bonds that have growing coupons, but obviously a bit more risk than a bond. So the iShares 20-year Treasury Bond ETF, ticker TLT, and the Vanguard Total Bond Market ETF BND are two popular bond ETFs that have held their own and outperformed AT&T on price return. But when we look at total return over those 10 years, they're at least all positive, but AT&T is still the worst performer. AT&T has a Simply Safe dividend score of 70, which is safe, a current yield of 6.07%, which is 6% below their 5-year average, and a forward price to earnings ratio of 7.5, which is almost 20% below their 5-year average. AT&T is currently paying $1.11 per share a year. So if you were to buy here at $18.30 and the dividend remains static, it would take you about 16 and a half years to be paid back in dividends. Now, AT&T did reduce their dividend after they spun off Warner Media, which I think is more of a right sizing of the dividend, but it was indeed still a reduction. AT&T's trailing 12-month free cash flow payout ratio sits at about 80%, but when we look at their trailing 12-month free cash flow per share of $2, that $1.11 annual dividend is only 55%, which is definitely well covered. Now, their net debt has been increasing since 2019, so this is something to keep an eye on, and I'd like to see it flatten off and hopefully start to be reduced. Checking in on Verizon, they have a Simply Safe dividend score of 87, which is very safe, and a current yield of 5.70%, which is 28% above their 5-year average, with a forward PE of 8.6, which is almost 26% below their 5-year average. Now, if you were to buy Verizon here at $44.92 a share and their dividend of $2.56 annually remains static, which it probably won't and looks to be due for a rise in November, it would take about 17 and a half years to get all of your initial investment back. Their 20-year compound annual growth rate of only 3% is woefully underpacing inflation right now, but it has been steady Eddie up and to the right for 31 uninterrupted years, with the last 17 consecutively growing. And as of the trailing 12 months, we see that all of their free cash is going to the dividend, and their trailing 12-month free cash flow share of $2.42 is not covering their annual dividend payment of $2.56, but I think we're going to see that ratio start to revert to the mean in the next year or two. Verizon's net debt is a bit high at 67%, but it is 26% lower than where it was in 2014, which is always a good thing to see, and hopefully that trend will continue. Check this out from CNET. The average US household uses approximately 514 gigabytes of monthly data, which was at 9 gigabytes in 2010, for an increase of 5,611% in almost 12 years. So these two companies have plenty of demand and growing demand for their services. Now, I'll be watching interest rates because the higher the interest rates go, the more that's going to draw income investors away from dividend paying stocks, especially those that don't have a lot of growth potential like Verizon and AT&T, because they're not going to have to worry about that equity risk, and they are obviously a much safer investment. And having too much debt also hurts, as AT&T currently has $129.7 billion of long-term debt. So an increase of just 1% means that AT&T instantly has an extra $1.3 billion of debt to pay down. But with inflation at 40-year highs, the debt should be easier to pay off because AT&T will still owe the same amount of money, but now they have more money coming in the door to pay off that debt. So if you do decide to invest in companies like AT&T and Verizon, you have to expect that there's going to be very little growth. Think of them as a bond proxy with a growing coupon, and if held long enough, you could be paid back in full for the shares, and all the dividends from there on out are 100% free and in the clear. I would love to know if you are buying either AT&T or Verizon, especially if you are a young investor. Share your comments in the comments below because you know where the comments go. And while AT&T's debt does look a little bit high, it's not exactly what it looks to be. I took a look at it in this video right up here next to my head, and if you check that video out, I will talk to you there.